Hi, my name is Roger Schlater. This video is actually about when you pay interest, when you get interest on your loan, having either caps or floors on the interest rate. And this could really help your loan, especially in a rising rate environment or in a high interest environment. I know currently when I'm taping this, it's a rising rate environment, but it's too early to tell whether eventually they'll just lower the rates, or if it's going to be a rising, a high rate environment for a while. So anyway, this video is really about having interest rates on business loans that will stop going up at a certain level. That's the cap. And then and really to the end, if you stay till the end, we'll see if this works on SBA loans. So anyway, there's either a cap or a floor. The floor would really be for the bank. It can't go lower than this, and a cap would be it can't go higher. So anyway, banks love it when rates go up. It usually means that they'll make more interest income. Remember, banks have a real reluctance to fix rates for a long period of time, and that is really because they make more money when they lend at the future higher rate of interest. In a rising interest rate environment, I mean, most banks want to make loans at a variable rate of interest because they don't want to have a loan and then have rates keep going up, and they could have made a lot more money, on the other loan. So it does provide protection from rate risk, and this is the risk that most of their loans will be lower fixed rate loans in an area of rising rates. The variable rate protects them from the rising rates, meaning that if you have a variable rate, it'll rise with the interest rates. It'll also lower with the interest rates. So anyway, you as a borrower want to have some protection against rising rates. And sometimes you can do this by having caps on your variable rate loans. They've done this in housing all the time, but we're talking about business loans here. Banks have the opposite opinion in that they do not want to let the borrower have caps on the interest rate that is charged. A cap on your interest rate is the maximum your loan interest will go up for that particular period. Borrowers are the ones that want the caps on their interest rate on their loans. Now, a floor on your interest rate is the opposite of caps. It will actually provide a maximum percentage of interest that the loan interest can go down on a particular loan. So caps and floors are used mainly on mortgage loans, but with a variable rate and to make the loan and to make a loan and loan interest more desirable for the borrower, especially in this rising rate environment or high interest rate environment. The banks will look at this a lot more. Caps and floors can be used on business loans with a variable rate of interest, and they also can be used on SBA loans. Borrowers usually want caps on a variable rate loan when rates are going up, or if rates are unusually high, the borrower is afraid that the rate will go higher. If a bank agrees to a cap on the interest rate on a variable rate loan, the bank is usually also going to want to put a floor on the variable rate as well. The floor protects the bank by giving the bank a maximum amount of interest that the loan rate can go down. You as a borrower, you don't care. You hope it goes down to zero, but banks usually will not let it go down that far. These caps and floors will only come into play if interest rates are volatile or they're trending up. If rates are trending down, the borrower may not want the protection, but the bank may want to stop the rate from going down indefinitely. A borrower will want a cap in a rising rate environment, and the bank will want a floor as a counterbalance for the rate cap. And also, when variable rates are trending down, the bank may want a floor on it. If the bank has a floor on an interest rate, the borrower does not want a prepayment penalty, because if the loan interest hits the floor and rates keep trending down, the borrower, will obviously want to refinance that loan to a lower rate. So just make sure you don't have that prepayment penalty. Business loan rates are usually the prime rate plus approximately 3%. I mean, they can be about anything they want to charge, but usually it ends up being that. If the prime rate, let's say, is 5.5, then the business interest rate may be prime plus 3, which would be about 8.5%. If this is a variable rate, the borrower may want a cap on the interest rate, at approximately, if the rate was 8.5, they may want to cap it like 10 to 12%. And it really depends what the bank's going to offer too. The bank in turn, if they give this cap, will also want a floor of probably an equal amount of interest. The floor would be the current rate, 5.5, plus 3%, 8.5, and then minus 2 or 4%. Minus 2 or 4%, which would put the floor at like, 6.5% or 4.5%. Banks always want a floor on the interest rate when rates are going down, when they're getting low. They do not want them to go to zero. That would be one crazy time for the bank. So they won't let them get that far. On a variable rate loan, when rates start getting really low, they will make sure that they have like at least a 3 or 4% floor on those loans. As for an example in a variable rate loan, let's say prime's at 5.5%. The bank is lending at prime plus 3%, which would be 8.5%. With a cap of 2 to 4%, this might go up to either 10.5 or 12.5 for the remainder of the loan term. This would be the max upside of interest rate on this loan. The floor would usually have the same amount of interest downside, or prime plus 3% equals the 8.5%, and could go no lower than 6.5 or 4.5, and that would be 2 or 4%. On the downside of the interest rate on this loan, the bank may also want a prepayment penalty if interest rates are headed downward. This would protect the bank for the borrower refinancing and give the bank a fee if the borrower would refinance. As rates trend lower, there would likely be no prepayment penalty if the rates are trending upward, because the bank can deploy their capital at a higher and more profitable rate. SBA requires caps and floors to be the same interest rate, the difference in relation to the rate and the base rate. So kind of an example was, if the base rate is the 5.5% plus 2.5, let's say it's 8.25. If the cap is 2% or 8.25 plus 2 or 10.25%, the floor would be the same distance from the base rate, or 2% going down for the bank, or 6.25%. Private loans from banks can do whatever they can get away with, but usually will standardize it and make sure that the rate is within state law. So anyway, that's really caps and floors. You can use them on commercial loans, and a lot of people forget about it. But if you have a variable rate, you really want to at least see if they will give you a cap. And then I guarantee they're also going to put a floor on it too. And then if rates are going down, they're going to put a floor, especially if they're getting low. So anyway, please subscribe to my channel. Hit the bell notification if you want to know about future videos. And please hit the like button if you learned anything on this video. Thank you. My name is Roger Schlueter, and I will see you in the next video.